Hey, everybody. Welcome to this week's Market Mavericks. I hope everyone's doing well. Welcome to Scott Melker and Mike McGlone. As we kick off this week, we got some fun stuff going on here. So I'm going to kick it off with my charts, if you guys don't mind. I just want to go over price action here. Again, this is more my wheelhouse with the technicals. But one of the things we are seeing here is Bitcoin beginning to break down out of really what I've been calling a bearish pattern of consolidation or a bear flag. And again, we talked about this in the previous sessions of this is your support line. You continued to hammer on it. We then touched that upper range. Now we've been consolidating at the lower range, and we are selling off now, trading just below 40,900 or 40,900. So I'll kick it over to you, Scott. What the heck's going on here? Give us the rundown.
It's really, really simple, and it's there you go. There's the bear flag itself. That's on the 4-hour chart. But this is not a technical event, man. This is a fundamental event, one that I sort of downplayed and disregarded as important. But man, this is GBTC, right? So what's happening here? If you guys aren't paying attention, we can see it over and over again. This is 10,000 more Bitcoin just sent today from Grayscale to Coinbase. When people exit GBTC, we have people that were trading the discount, as Mike talks about all the time, but more so, we just had a ton of people that were trapped in there and they couldn't redeem for years, who are either looking to rotate into a cheaper product or just to finally get out of GBTC. Well, every time those people sell their shares of GBTC, Grayscale has to send some Bitcoin over to Coinbase and sell it on the open market. And that's what we've been seeing. It was like 2 days ago, I believe they sent $800 million worth. The next day was $600 million. Actually, before that, today, this morning, it was $450 million. This is 10,000 more Bitcoin that were just sent today. So this is just intense selling pressure on the market. People are blaming Grayscale. This is not their fault, guys. This is the mechanics of GBTC. If someone sells a share of GBTC, they have to liquidate that Bitcoin. So the good news there is that we're still kind of holding up around 41,000. Honestly, if you had told me we were going to see, 3-4 billion immediately sold on the open market, I would have thought we'd be much lower. And it can't go on forever, right? The people who are looking to get out of GBTC are doing that. There's T+1, T+2 settlement, so they sell their GBTC. That second day, we're still seeing the delayed effects of that coming onto the market, but that is pretty much what's happening here right now.
So are these people selling their Bitcoin via GBTC and moving it into spot ETFs, other spot ETFs, or they're just exiting Bitcoin totally?
I would say a lot of it is the latter, that there is some rotation, but we're still seeing, even with all of this pressure, which I think you can consider a separate event even from the ETF launch itself, but we're still seeing massive net inflows into these other products. A lot of that may be some from GBTC. BlackRock's product alone just hit $1 billion in 4 days. That makes it the third most successful ETF launch of all time after BITO, the Bitcoin Futures ETF, and GLD, of course. And that's with 10 competitors on the market at the same time. So these are massively popular. We just have the overhang of GBTC sell-off happening right now. But I would say a lot of people, they sell their GBTC. It takes a little while to clear. So a couple days later, after T1, T+1, T+2, or whatever, now they're probably rotating into something with a lower fee. Now, I'm sorry to keep talking about it, but if you're in a tax efficient account, if you're doing this in an IRA or something like that, then you're 100% going to sell your GBTC and move to something with a lower fee because there's no tax implications to doing it. GBTC, by keeping that 1.5% fee when everybody else is at 0.2, 0.25, they made that calculation. They said, listen, everyone who's in an RIA, they're going to move out. But a lot of people are trapped here because they're going to pay massive 20-25% capital gains on selling their GBTC. So it doesn't make sense to go into something cheaper. So they clearly know the model of how this is going to work out. We're just seeing it all hit the market at once.
Is there any sort of gauge on when this selling could subside, or is it we just don't know at this point?
I think we don't know at this point. I mean, I think a bulk of people are still going to stay in GBTC. I think it's still going to remain the superior trading vehicle for ETFs because of the liquidity. You can get $1 billion in and out of GBTC right now. You can't do that. If you're a large player, you can't do that with any of these other ETFs. But very hard to gauge. I would like to see it slowing down, right? Yesterday, I think it was 800 million. Today, now 500 or 600. Maybe that's slowing down. I don't know. I would imagine we're going to see it, for at least a couple more days, if not weeks. But then, hopefully that demand remains and we don't see that diminishing and it can boost price once again. But this is a very fundamental event that's rocking price. I mean, the NASDAQ's at an all-time high today and Bitcoin's dropping, right? So,
yeah. So speaking of all-time highs, Mike, talk to me about how is the Bitcoin short-term top something that could be a risk-off event that could influence the S&P and the Nasdaq?
I think it's the key leading indicator, like we kind of discussed this before, and I think this is a good piggyback onto piggyback into GBTC. I've been watching this one for a while. Just take the GBTC versus GLD cross, and it used to lead beta, I mean the S&P 500, which is what this is. Now it's lagging. It looks like it potentially is rolling over, and it's a very legitimate cross now because GBTC is the number one by far ETF in the Bitcoin space. But it was almost 30 billion, maybe it's down to 26 billion, and GLD is the premier benchmark ETF in the gold space. But the key point I like to point out is it's lagging. It started lagging beta since the peak in 21, and it's got an issue now. But I want to point out one key thing I think that matters is this is futures open interest on the CME. And I know people who were doing this trade, bought the GBTC at that discount last year, so just started rolling futures and different other products to hedge it last year. And boom, it worked like a charm. It wasn't perfect. And then they're taking off the short futures and selling GBTC. So some of that, a lot of that GBTC, as Scott pointed, is going on to these other ETFs. But I think a lot of it's just taken off the ARB trade of the year last year.
I agree. It's going right to cash.
Yeah, and like you're getting 5%. So I want to just go over some of the macro that I'm watching in the big picture. Right? It's like looking at going back to gold a little bit. What I want to show you is to me some of the silliness in this market that really I think maybe Bitcoin's picking up on by going down, and that is what I show you in white. That's the VIX volatility index minus the Fed funds rate. It's a 12-week average. It's the lowest since 2007. Now, this was one of the best signals I ever had when I was trading. I don't trade anymore, to get long volatility. It's just so low. You want to be long gold and short the S&P 500. So here I overlaid this. When volatility gets this low, doesn't have much room but to go up. And that doesn't happen overnight. But this Bitcoin, this gold GLD SPY ratio is buried. It has a much greater tendency to rally. So I think that's a key silly thing the market's pointing out. And also the market's coming back a little bit. When that's this silliness at the beginning of this year is pricing for 170 basis points of easing in a year. Now we're down to, this is our WIRP page, we're down to about 160 basis points of easing coming within the next year. And I don't think that's going to happen unless the market makes the Fed do it. Now, they said they might cut 3, but that's a lot of cuts. So I want to dig in some other things that I think are really significant. That is continuing deflation in crude oil. And I really enjoyed how so many people were bullish crude oil last year. And I look at it as fit it into a portfolio, do your value at risk model, and compare it to all other commodities, all assets. If you just compare crude oil to corn's the most significant agriculture product. That's what I show you here. Crude oil should be around, it should be right down here. I'll just show you the crude oil line. It should be down about 43. Now, did it natural gas, it should be about 30, so I didn't bother. So here's a key thing I think that's really going to matter this year is crude oil and copper, the most significant macroeconomic related sensitive commodities. And I've been doing this since 2019, and this is what I'm comparing because that was the key year. You set in before COVID and then the Russians' invasion of Ukraine, and they're basically right on the same performance. And this is an auto scaling. They're both ready to break out. I think the risk is they go down. And I want to show you one key thing that's been happening over time. If you just look at gold versus broad commodities, that's that white line that Scott has pointed out to me and other things when I show him. That's clearly heading higher, and it breaks out during recessions. And one thing I want to point out is gold ETF holdings have been declining. At some point, that's going to go up. And I think it's going to take a correction in the stock market. But I want to end on this, and then we can go to other things. The macros it gets, bigger picture macro. And I say it's facetiously, but is it different this time? So what I show you is the treasury curve from the end to the end. I like to look 30-year yield. I used to trade those in the Board of Trade, 30-year futures versus Fed funds. I mean, it looks like we're finally bottoming this inverted yield curve. It's still the most inverted in about 40 years. And at the same time, I show you unemployment, it's just starting to bottom, just getting started. I mean, stuff is so big picture macro, the day-to-day doesn't matter. And that's for impatience, which I've been, and we have to look forward to the next 6 months or so. This kind of stuff I expect to matter and kick in, and Bitcoin might be the leading asset to show us that all we did last year was all risk assets went up, and this year the risk is they just go back down a little.
And do you think the risk is that risk assets sell off because people have gotten too bullish on the narrative that the Fed is going to cut 6 times and all
Oh
these
yeah.
other things? Is it so they've just overdone it to that one side?
Well, here's the key things that so we've overdone it. The market it doesn't care too much about economic activity right now. As Milton Friedman said, it's more about monetary phenomena and its monetary potential. And the market's so priced for this ease. Oh, the Fed's going to come in and save us because they've always done that. Um, that it's forgotten. Well, that was before we had the biggest inflation in a lifetime because we created too much liquidity. So the market is way priced for tons of ease, and it's got to get that. And in the meantime, we have volatility from this measure. If you just look at volatility, it's so low, and interest rates are so high. Just a little reversion over there. That's what I show you in this chart, comparing, using volatility and interest rates together. These are levels when in stock at risk assets are low, okay, you don't care. But when risk assets are at the highest ever, as Scott mentioned, the Nasdaq is at all-time new high, you probably should say, okay, thank you. This is not where you're supposed to be overweighting. Last year, the right thing to do was overweight risk assets. Bitcoin went up the most. What's happening this year? So far, it's just showing a little bit of, I would say, fatigue.
Interesting. So just in terms of talking about a little oil here, I just want to show you guys this. And this is again, I'm a much shorter term outlook trader versus what Mike is showing you, or oftentimes even what Scott's talking about. But there is a little bit of a breakout potential on oil here today. Now, this is again just a short term move, but you got a little inverse head and shoulders here, and look at that neckline from here down to here, and even you pierced it here and got rejected. But today we are above that level. And again, just in terms of the measured move, this might, in the short term, at least according to what I'm seeing on the charts, send us up in the next couple weeks to month or so, maybe back to the low 80s on spot crude. So just interesting little tidbit there. And again, who knows if the culprit is Mideast tensions, whether there's something else going on. Who knows if we're going to get, the jobless claims number. I thought that was astounding today, 187,000 jobless claims, even lower than we've been for a long, long time. I don't know if there's some other factor in there, but that was a little bit of a shock to me as well. Scott,
don't worry, they'll just revise it when nobody's looking, Gareth.
Yeah, I know.
Can I just do a little follow-up on crude oil? One thing about crude oil now is because of what's happening with Middle East tensions, obviously I show my crude oil chart in orange overlaid with corn, it's have a tendency to go up on Fridays. Now, tomorrow's Friday, and we had some inventory data, and then because it has to price in for the risk of something happening over the weekend, some kind of supply shock, and then it goes down earlier in the week. That's just what happened again the last few weeks. So that chart you showed breaking out, it's tomorrow's Friday, might be part of that, and then we'll see what it looks like come Monday, Tuesday morning with missiles flying right now in the Red Sea. You got to be careful.
I was going to ask you, Mike. I mean, how concerned should we be about what's happening in the Red Sea? This is so above my pay grade, but it really seems like things are devolving, and this becomes the kind of situation that's legitimately problematic for supply for
China and Europe.
Assets and commodities.
So most of the flow is China and Europe. Here's the unique aspect of what's happening here, and people poo-poo the dollar. Who provides the security on the open
Only
seas,
us.
The U.S., right? And who's the major shipper shipping stuff through the Red Sea to Europe? It's China. China's like saying, thank you very much, U.S. You're projecting the open seas for us. And they might be interested in their own areas, South China Sea and everything, but that shows how significant the U.S. is. But it also shows I think what's the issue there is here's a whole continent, particularly Germany, it's already in recession or tilting there. And they just were a few months ago hiking rates at the greatest pace ever. Haven't even started providing liquidity. So that's Europe. And then we have China, which all my data shows is just starting to revert lower. The demand estimate revisions heading lower out of China are just phenomenal. Things I've been waiting for a decade. So, and then when you think here about Saudi Arabia cutting production, now they tried to cut supply recently. Who's that hurt? China. It's like that area there is bad for what's already tilting bad in the rest of the world. But as far as energy flows, it's bad for maybe Europe and goods, but the U.S. is a net exporter. I'll end with this. Here's the fact of what's changed in the world, the paradigm shift. With Canada, the U.S. and Canada, crude oil and liquid fuels, our excess of supply over demand is about 6 million barrels a day. That is what OPEC spare capacity is now. It keeps rising because they're cutting production to make up for how much excess supply is coming out of the U.S. and Canada.
Hey, Mike, have you read this? By the way, the end of the world is just the beginning.
I got something. I haven't read that one.
I literally grabbed it from behind me by Peter Zeihan when you were talking about that. I was just reading this again for the second time, but showing the global oil routes here. And half this book is literally about the death of globalism. I mean, that's what's mapping the collapse of globalization. And largely the bulk of it is talking about how without the United States protecting the seas, there is no globalization, period.
Oh, exactly. And well, that's a key thing people have learned with this invasion, 2 invasions recently, is it's indisputable, far from perfect, but the business of U.S. is business, according to what I think Herbert Hoover said that many years ago, and more so than ever. I mean, there's a lot of good baseball players coming out of Japan for a reason, and why? Because the Germans didn't like baseball, but they're defeated countries by the U.S. It's just the lessons I heard economists say, if you really want to get wealthy economically, you cozy up to the U.S. China did that. Now they're completely pushing back, but the thing is, they triggered it with a war. Maybe not theirs, but it was somewhat connected. And now their best customers are doing everything they can to get out. So I see this as just an overdue implosion. So the deflationary forces out of China are accelerating. Their PPI is down almost 3%. US PPI is down on a year-over-year basis, and you have to look at that a year from now. Is that going to get better? So I think it's just starting to tilt lower. And everything, the one key factor that disagrees with that is U.S. stock market, as you mentioned, just keeps going up.
Yeah, just pointing that out too. You guys talking about China. So you had the Hang Seng stock market down 30, almost 33% in the last year, the 52-week range. Yesterday it had a small bounce, but I mean, it's been in free fall after their GDP number earlier this week. We do have some support down here on a technical basis going back to October of 2022, which is when the stock market in the US bottomed, right? And I think this is fascinating. You look at this chart where they both bottomed at the same point back in 2022, but this chart of the Hang Seng is basically back to those lows, while the S&P is essentially at 52-week or all-time highs. Amazing. And then you cross-reference that with the Nikkei, which is hitting 30-plus year highs, right? And you have this kind of disparity in Asia of what's going on. And I don't know if you guys have any insights into what's going on here with China, with Japan.
So here's the latest I saw in the Bloomberg terminals morning. Is there was a decent bounce in the CSI 300 last night, and there's speculation the Chinese are starting to buy ETFs like Japan's been doing forever. So I show you, that's why I'm glad you showed that chart, that we still have that little gap below in the S&P 500. I'm not saying we can't make a new high, but we've hardly, this goes back, S&P 5, this is E-mini, so weekly. I think I'm back almost 20 years in it. We've never had a gap that wide and that long ever. So simple gap maintenance. But what you're seeing in China is now it seems like the authorities are coming in, they're starting to kick in fiscal monetary stimulus, and that's what the Japanese have been doing, is buying not only JGBs but ETFs and stocks. The key thing, as you point out, is it's still below the peak from 1989, 1990 in the Nikkei, and we're catching up. But the peak in the Chinese stock market, 2007, was more extreme than that Nikkei peak.
Wow.
30.
So see in 30, 40 years for China if they ever come back, right?
We'll see, but right now we're in that early mean reversion stages. But this year should be a main one. And every time I hear about bad data coming out, obviously I'm reading another book called The Price of Time, which points out some of the negative things that's tilting in China. Ray Dalia's book Principles shows the opposite, but I think he's a little bit off there. That was from 2 years ago. But it's just it's really starting to trickle that day. The thing is, they're starting to pull back on negative data. I mean, if it's bad data, they stop publishing it.
Is China's troubles self-inflicted, meaning like, them cracking down on their own companies, the trade war where now the US's biggest trading partner has gone from China to Mexico? Is it more self-inflicted, or was this like inevitable?
Mr. Z is the exact opposite of Ding. Ding came in 74, 75, tilted over to a communist version of democracy and capitalism, and it worked, brought people out. And so now, and Mr. Z is completely opposite. I'd say it's one person, very inward leaning and doing the exact opposite things that you need to do to really expand in the global economy. The key thing, as I like to point out, is it just expanded too far too fast. It's just a simple high price cure. And we're just reverting right now. I just don't see what stops it. And I keep hearing people pointing about demand estimate revisions potentially picking out of China. I'm like, where? Is that going to export more to Europe? No, Europe's heading towards recession. They're getting out. Are they export more to the US? No. U.S. is getting out as much as possible, and they're both potentially heading for recessions. And then there's a property crisis, which every day I read from my BI colleagues is just getting worse.
Yeah, and I think, in the short term, anything can happen. But when you look at the population numbers in China and what's likely
There you
going to
go.
happen there, it's absolutely
Yeah.
astounding. 2 years of population decline in a row. I think now they're down to one child again on average per
For two
woman.
people, right?
There's just no, like, you want to talk about supply and demand. They have the oldest population in the world that's going to need things, and they have nobody to make them.
So
At the most basic level. So, I mean, their population collapse has
And
put them so far behind the 8 ball in the future that I
one
literally
other
don't think they have a
additional
chance.
thing on that. I'm glad you went there. For one additional, there's so many little iterations here, but one lesson I learned from that book, the 21 Lessons of the 21st Century by Yuval Noah Harari, I read it years ago, is you never want to be
Sapiens.
bullish.
Yeah.
Never, he wrote Sapiens. So yes, Scott, you guys are obviously good readers. I'm not. But his point was you never want to be bullish a country that has problems with what people do not want to immigrate to. And that shows. Do you know anybody who's trying to immigrate into China? But I look at the CNN screen in front of me, and just the last few days ago, I see a lot of people are the mass of people trying to get out of China and actually coming up from South America and trying to get into the U.S. It's just it's a flood that's not, it's a trickle that's flooding now, and it's just getting started. The data I'm hearing, and just by the facts that you're seeing. So I look at people when you say you're bullish China, I'm like, okay, let's see a reversal in that the fact of people wanting to immigrate to China, and just like the exodus from Hong Kong.
Well, and I think part of that too is the youth unemployment still at 15%.
Yeah.
So I mean, if you're young and in China, you're not doing so well. I mean, 15% is high. Imagine if that was here in the U.S.
So how do you know that? They stopped publishing that data when it got bad.
And we believe them.
Well, then, okay, I should say 15% or worse, because they would be publishing it if it was
with a margin of error.
Yeah. Crazy. All right. So where do we turn here, guys? We got about 8 minutes left. What's the kicker here?
I think I'll just end with this. I think the bottom line for this year is volatility is always mean reverting. That's a lesson I learned in trading in the bond options pits in the Chicago Board of Trade. And volatility on the VIX minus T-bill rate is the lowest since 2007. So that's just not a place you want to be aggressively buying risk assets, and Bitcoin's one of the riskiest.
So, Gareth, I want to know what you're trading right now, man. I know you're always asking us questions. You started with your charts, but I know how you're looking at Bitcoin. What else are you looking at right now? Because I need a little dopamine hit.
No problem. All right. So I've got my account over here on one of the other screens. So first of all, just looking at the SPY, we're still stuck in this tight range, right? So this is a range here on the S&P where you have to favor the upside until proven otherwise, right? So if we break this trend line, then that's where I think the floodgates open. We hit it yesterday. We bounced today. We're having a big rally to the upside. The S&P is up about 0.85%. Now, in terms of what I'm trading, I did start nibbling on UNG today, which is natural gas. The UNG here, if we bring up natural gas's chart, it retraced back into a support level. And again, this is a short-term trade. Let's be clear on this, right? But basically what I see here is you have this low here to this low here, right across. And you can see how we hammered on this level and then finally broke out. One of my favorite trades to do is when we have a breakout. I don't buy the breakout, right? I'm usually late to the party at that point, but it's waiting patiently. If it comes back to that level, this now becomes support. So we'll see. We can update it next week how that one's going. The other thing I did do today, I picked up a short on Visa, right? So Visa here, and these are member trades in the service I run, but Visa hit a new basically new all-time high today. It continues to go up. The chart is absolutely incredible. And the one thing that caught my attention here is DFS, Discover Financial, which is another credit card player here, is down huge on the day, about 10%. And one of the things they were saying is that they're basically having to put more money aside for people that just are stopped, that they're not paying their credit cards anymore.
I was gonna say, how can credit cards be down when
right.
credit card debt is up?
Right, exactly.
Levels, so that makes sense. They know what's coming.
The thought process on a swing here is that I'm at least going out on a limb saying that based on the valuation. I mean, look at this weekly chart. It's 1, 2, 3, 4, 5, 6, 7, 8, 9, basically like 12, 13 straight up weeks coming into earnings for Visa. I think that it's already factored in amazing earnings, and the thought process is maybe we'll see a pullback on earnings here. So those are just two little trades that I've taken today. I'm still in the camp that I think at some point this year we will see a big correction in the markets. It's just I don't know if it's in the next month or if it's later in the year, but I do think that the markets have gotten into this hopium range of 6 rate cuts being great. And I keep on saying to myself, holy cow, if the Fed has to cut 6 times, are things really that great in the U.S. economy?
But they
and our
still
valuation
keep going up. It still keeps coming up, even as people start to price the cuts further down the road. We all know that
True.
the predictive markets are wrong. It just blows my mind. I mean, yeah, Nasdaq
Yeah.
making an all-time high when people right now are, talking about, oh, maybe they won't cut in March, and maybe they won't cut in May, and it's just, yeah, it's pretty
But I
crazy.
do wonder, and I do wonder how much of this is like, so you have the crypto trade, which is cooling off now, but then really it comes down to more like you look at Nvidia, right? It's just unstoppable at this point. AMD, I mean, this AI trade seems to be fueling the speculative rally where these stocks now have taken over. The Magnificent Seven are still rocking. I mean, Microsoft's nearing 400. It's now the most valuable company in the world. But I do think that, again, it's a lot of speculation on this hope that everything turns out okay. And it's just, maybe I'm a cynic, but it's just, I don't remember the last time the Fed nailed something dead on. And so I'm not expecting them to, which means there's a hiccup coming at some point. And like Mike mentioned, the VIX is at historic lows here. Gold is ready to break out. Gold breaks out either if the dollar falls or if we get panic in the markets. And the chart is telling me that the breakout is coming. So yeah, it's going to be an interesting next couple of weeks. The last thing I would be curious about, Scott, is what's your take on some of these altcoins? Do you have any altcoins like thoughts on
I
like
do.
Solana or Ethereum?
And to be honest, I'm still just massively bullish Ethereum, and I have been for a very long time. Listen, I don't make many calls, but and I don't talk about many things, but I was beating the drum pretty aggressively for the last few months that Ethereum was starting to bottom here and likely would. We saw what happened, obviously, on the ETF trade. If anyone's wondering, this is the Ethereum versus Bitcoin pair. If you're wondering why I would look at Ethereum versus Bitcoin, most people who are trading crypto are looking at Ethereum as sort of a bellwether for the entire alt market. And most people are trying to beat Bitcoin, right? Because either you want to be in Bitcoin or you want to be speculating on other things, right? When Mike talks about the entire market and viewing Bitcoin as the leading risk asset, when you're in Bitcoin, Bitcoin is the safe market. And these are the other leading assets, in some degree that tell you what they're going to do. And Ethereum has had just a massive move up against Bitcoin. And if you look at it, the USD pair, it looks bad. But even as Bitcoin dumps here, which lends to my sort of theory that this is all the GBTC unlock and selling, Ethereum is holding its own and even continuing to rise slightly against Bitcoin. So I think I think we had a kind of a little blow off top there for this little miniature alt season we had there. Not surprised at all, but I really do think we're going to see a major rotation into Ethereum when things heat up again.
Is there an opportunity in like the GBTC type trade for Ethereum? Like is there a discount there or not?
ETH. I think it was like 12% or so, right, Mike?
I was just going to go there. As we're reading, I'm talking. Its discount is 15%.
15. It's lower. Dropped.
Yeah, and so it was 60% last year, and it went up with GBTC. But what does it have that Bitcoin doesn't have anymore? The dangling carrot of ETFs will be launched.
ETF.
Not potentially, it might take a year or two, but at some point, unless the whole system fails, it has that going. That's my problem with Bitcoin. We've already had it. You have the light at the end of the tunnel. We've reached it. Wonderful. So there's the ARB that might be worthwhile. If you want people looking to buy ETH, there's that product. It's at a discount. But I want to show one thing, if I can, piggyback on what you said, Gareth, about UNG. It's showing why UNG, natural gas, is a tactically trading market. Should always trade it tactically. When I was at S&P, the only index I ever had to rebase is the natural gas index, because that contango will kill you. So what I show you in white, that's just a UNG price since 2008, and overlaid it, and I show is GLD, the two top ETFs there. That's why I'm kind of bullish gold. Typically, commodities go down. UNG's the most extreme example of why a total return will go down. You trade it, though, and there's some great opportunities for trading. You're doing that. But buying, holding, even trading, if you're in commodities, you always look for gold and maybe the digital version in Bitcoin. But that's the key thing. When you mentioned UNG, I want to point out that be very careful buying and holding those type of assets.
Yeah, they
really
call it the
Gareth,
Widowmaker for a reason, right?
Well, the last Widowmaker was GBTC when it was at a premium, and that's why we saw BlockFi and Three Arrows Capital and all of them collapse because it went to that discount. I just see people asking how much more Bitcoin does Grayscale have to sell. I want to be clear. They're now holding about 590,000 Bitcoin, but that doesn't mean they're selling them. Just to be clear, they're only selling Bitcoin when somebody sells their GBTC shares.
Right.
So
which is a standard ETF thing, right?
Grayscale is not liquidating all of their Bitcoin. This isn't even Grayscale. This is literally just balancing so that the underlying asset matches the NAV.
And I think that's important to understand, folks, is like an ETF that has an asset that it tracks, you know, they have to hold that assets, but it goes up and down based on sellers and buyers, right? So this is like Mike, like Scott is saying, it's that's super standard here. People are just selling it, so then they have to sell it. If people buy it, they'll just start buying Bitcoin back.
Yeah, this is this is the mechanics of how it works. This is not them actively making a decision to sell.
Awesome. All right. On that note, guys, this was an awesome episode. I hope everyone enjoyed it. We had a great crowd watching. Thank you guys for joining today on Market Mavericks. And you guys make sure to go follow these gentlemen. They have great information consistently. So on that note, we'll see you all next week, next Thursday at 3 p.m. Eastern time. Take care.